Good morning, everybody. Welcome back to the Opportunistic Trader. It is November 20th, just after 11 o'clock, and we're joined by Henry Schwartz of Trade Alert. Henry joined us 2 weeks ago, I should say, showing us different interesting ways he looks for risk-reward opportunities using his software. He's got a lot of great information on the Trade Alert software. You can find tradealert.com. You know, it scours the market for a lot of interesting opportunities, and so I'm going to let Henry in these volatile markets take it over and show us what he's looking at and the ways he kind of parses through everything.
Great, thank you, Michael, and hello, everybody. It's definitely not a boring time to be trading. I was at a conference last week and just kind of going over some of the kind of regime change that we've had in the volatility space, and it's pretty wild, kind of on a year-over-year basis. If we pull up something that shows like implied and realized, versus the nowadays, we're really hanging out in the 20 zone right here, versus pretty much all of last year. If we go back a little bit further, it was, I mean, everybody was talking about how it was this unprecedented, incredibly low vol environment. Realized was 7, VIX was under 10 for weeks at a time, and now we're back to some excitement. So I think from a trading standpoint, more volatility is good. Obviously, if you don't get yourself into a corner, if you keep some dry powder, but it's we've seen all sorts of opportunity. I'm going to show off a couple of the approaches that we look at. If you were listening a couple weeks ago, option activity and order flow dynamics is our focus. It's kind of all we do. It's I've been in the option business for 25 years. What we tend to start with is taking every single trade. And there's 4,000. There's options on 4,000 underlyings. There's almost 1 million strikes out there now, which was actually one of the topics last week, because there's actually about 935,000 individual listed options, and it creates a lot of interesting dynamics and a lot of stresses on the participants. Just think about quoting 900,000 instruments, and you got to keep in mind, most of the market making now is done by a handful of firms, right? Citadel, Susquehanna, and the infrastructure and the risk controls you need when you have almost 1 million live quotes out there is significant. But what we tend to do, and you can actually kind of see it hitting on, this is our option alert market monitor. Basically, we take every single trade. We identify if things are trading on the bid or the offer in real time. Based on triggers, we send out the trades so that people get what they want. So if you trade biotechs, you get biotechs. If you specifically are looking for, deep out of the money call buying through the offer in semiconductors, you can kind of set up a trigger for that. But like I'll even kind of zoom in on one right here. I'm going to type pause so that it stops rolling. But here's a trade in Western Digital. 1,000 of the D51 calls trading for $1.10. What we do is identify that was a buyer. Okay, that's based on some market modeling, but basically it's still relatively simple. The market was 103 at 110, and 1,000 of them, 1,018 traded at that offer. We actually had a couple more important points of reference. One is the theoretical value. So this $1.10 can be compared to a theo of $1.07. We're sourcing that from a company called FT Options that basically runs market maker pricing for us. And then we actually aggregate the pieces of that trade. So this is kind of wild, and this is how the option market works nowadays. So 1,000 of these traded, but you can actually see there was no single chunk that was bigger than 250 contracts. And so what you had was 14 legs that touched 5 exchanges that traded in 34 milliseconds. So that's a very typical, that's actually about how about 40% of the activity is executed. So then, this is what we're doing kind of in real time. And, I would look at this and say, okay, well, this is an opening call buyer. The stock is $46. These expire in was about 5 weeks to the D's expiration, 4 weeks, and they're $5 out of the money. So what I would kind of then do, whoops, got to actually type it, is zoom into the activity. Okay, so there's a couple things that jump out. Okay, the first is the volatility in there is at a 52-week high, and if you actually take a look at the kind of the volatility structure, this is the at-the-money vols for all of the listed expirations, and then we're also plotting some constant maturity points, these 30, 60, 90, and so you can actually see where the vols were yesterday, which is the red line, and then where they are today. So you see kind of a pretty significant vol jump across the board. Now, with the market being down, that makes some sense, especially if you're looking at SPY or something. But Western Digital is actually up on the day, so it's a little bit funky to see that that vol lifting up when the stock is actually pretty strong. Looking at kind of the the most actives in that class, we just saw this 1018 lot of call buyers go by. That's the most recent decent sized trade, but a little bit before that, there's actually looks like there were some put sellers as well. So I'm not saying that kind of directional sentiment in options works 100% or 100% of the time. It doesn't, but you also know that that options are sophisticated instruments used by very smart traders and funds. I usually say that people that don't really know what they're doing don't last very long at all in the options space. So, I look at the couple of trades here right around 11 a.m. and see, okay, well, this one traded before, so somebody sold some D's 35 puts below the bid that was showing. Okay, now there was only a one lot bid for, but they blasted them down to 38 cents. That's when the stock was 45.55, and then this is 3 minutes later, 4 minutes later, they kind of piled on. I'm kind of assuming it's the same trader, not necessarily, but doesn't really matter because the flow is pretty consistent. Put seller and call buyer around 11 a.m. And as the stock was lifting up. So if I can pull up, let's see if I can split off a chart that I can drag over here. This will work. Looking at WDC here. So this is just today's chart, but so 11 a.m. is when this all kind of happened. So the stock had bounced almost 60 cents off of its lows, and somebody finally said, okay, I'm in. And that's what we kind of try to look for. We try to quantify. Trying to trade off of it, there's a couple different ways that I've seen people have success and that I've had success myself. Sometimes just going along with the flow, and sometimes looking for kind of almost an overextension. And if people buy calls and sell puts, there is a natural reaction in the stock. Basically, just think about it as the hedge goes out, and we actually kind of add that up as well. If we look at the impact on these WDC trades, you can actually see that 1018 lot was equivalent to 28,000 shares to buy, and the earlier ones looks like they were a little bit below that. But like here's a put sale of the D's 35s earlier in the day, and that was 17,000 shares for to buy as well, right? Because they're selling puts and buying calls, so that creates some upside pressure in the stock. Now, in a lot of cases, the hedge may be going up in ETFs and things, so you're not always kind of guaranteed to see it play out in the stock. It tends to work best in these oversized trades where, say, if we look at Western Digital, the average daily stock volume is 7 million shares. So, if you have an option trade that is equivalent to 10,000, 20,000 shares, there's not really going to be any reaction, right? It's an insignificant percent. But get over 50,000, get towards 100,000, 200,000 shares, and you're up to 1%, 2% of the daily stock volume. And if it's in the form of a sweep, which tends to be a surprising trade to the participants, right? I mean, a negotiated block that gets crossed on the Philly or something is not at all the same as one of these multi-market sweeps where they lift the offer on a dozen exchanges. So when we're looking for kind of the most compelling directional stuff, that's really what we're zooming in on. And in fact, like the way that I set up my triggers is I will have the system send me these trades where that is true. Basically, multi-market sweeps where the net impact is greater than 1 or 2% of the average daily share volume, and specifically looking for these trades that are opening new positions, which is just just by default of trades that exceed the open interest. Are going to be opening option trades. So it's not a perfect science, but it does tend to pull out the stuff that is unusual and unusually sized. So one that I was looking at also kind of on a bigger time horizon is the China ETF. This has been, obviously a lot of the macro headlines coming out around this trade war with China and the upcoming G20 and all sorts of geopolitical issues. But take a look at the option volume in FXI over the last couple weeks. Okay, we'll get here. We can get a little bigger time horizon. So over the last 3 months, we've seen some big, a couple dynamics here. Call volume dominating the puts is one. In fact, I think the average put call in FXI now is 0.49. Okay, so that means that we've been seeing call volume twice the puts run in an average sense. You have a couple other issues going on. The underlying level has slid as this sell-off has been somewhat global. And things have gotten much more volatile. So on this little chart here, this dashed blue line is the implied volatility. Here's your stock price, the solid light blue. And then we also look at one other thing, which is the skewness. And I think I mentioned this last time, and it's definitely somewhat esoteric in terms of what option traders like, how we like to think about things. But there's this put call smile that basically you see because there's a demand for puts a little bit over calls in a out of the money sense, and that more or less comes from the fact that people hedge their portfolios just like you buy house insurance. People are willing to pay a little bit more for puts because they're long and they don't mind kind of paying a little bit over value in terms of the downside insurance. So you can track that, and that's what this line right here is. We'll get rid of all the other lines, and this is just a measure of skew. The way that we do it is using a 25 delta call and put, but there's a bunch of different ways you can go at it. But it's an interesting number to track because what happens is when there's a lot of panic and people are out there, kind of frantically trying to hedge, you'll see this number spike. Let's see if it looks any different in SPY, because that one can be a little bit more obvious, especially if we go back to the beginning of the year when the world ended for a few minutes there in February. Here's a good example.
Wow, that's really telling the difference between then and now.
Yeah, this is what I was talking about at that conference. Is February was a blip that basically scared the crap out of people in terms of the at the money vol level and in terms of the skewness level, right? So this blue line is the at the money vol level. It shot up. We saw VIX get up towards when it blew out the vol products. I believe it was.
Is the chart we're looking at real time as of pretty much right now?
This last number is going to be updating.
So what do you take of the fact that we're, as of about 45 minutes ago, we're making new lows on the year? Actually, I shouldn't say new lows on the year, but new lows since that February move. But the skew hadn't moved up. Is that something you would take as actually bullish, that people aren't panicking, or the fact that maybe that's more bearish because it means that people aren't panicking yet?
Well, I would say that it's a little bit bearish in that we don't see the panic. And it's also, we were talking about this a little bit, is it's a little bit, it's a different dynamic to have the market melting down into year end than it is in February. I think that this was just a wake up call. And I mean, you'd had in 2017 the market was, what were we up?
Well, that was the slow grind, historical slow grind, where we never had, like, I don't know the exact number, but 0 days of down 1%. I think there were 8 days total of a 1% move, whereas every single day we're moving about 1% more recently.
Right, and that's what you can see right here from since October, basically. You've got the at the money vol level, staying up in the 20s. I mean, we've got realized volatility around there too, so that makes sense. And this skew, it's elevated, but it's not spiking, and that I guess is your question. It spiked here because there was a panic. I mean, there was I've got some data on a couple days on February 5th and 6th where the markets blew out to levels we hadn't seen in years, and that's not happening now. Now you're seeing elevated concern, right? Because the steeper the skew, the fatter the tail to the downside, right? So it basically is a way to express the expectation of the the probability of getting to the downside. I think that the hedging kind of fell out of fashion last year because it didn't work. It just cost people money. And through this summer, although open interest was going up, there kind of was a lot of talk about how hedging, people didn't need to hedge anymore. So I would say this makes me nervous in terms of kind of elevated vol without when this spikes is the end, right? That's when people have given up, and you see that capitulation that that you're always waiting for, and it happens every once in a while, and it tends to be the opportunity. The opportunity that doesn't come along very often. So we don't seem to be there. This now we're kind of having the steady grind lower, and every morning people are like, geez, we're going to be down another percent or two, and sure enough, that's what you see. I don't think it's gotten. I guess it feels to me like it could be a little bit more violence to come on the downside. So at the same time, I also think you get some of these big. This morning we were down 60 handles almost in the S&Ps, and that even within that you can see kind of some capitulation, some just people selling because they have no choice anymore, getting stopped out or whatever, and that can be a chance to jump into. So in terms of the option flow, that's what we do look for. When the market's really kind of down on its extremes, and then you start to see a bunch of kind of call buying as it kind of wavers there. You can see, you can kind of get a sense where, okay, some people are actually starting to put some money into these trades. And with short-term options, I can show you the one I was looking at in FXI earlier, was the 35s that expire on Friday, right? So these weeklies give people the ability to make these very short-term bets.
Yeah.
And you got to pay attention to it, especially when it's a significant amount of money. The biggest trade that we noted in here this morning was this 20,000 lot call spread in FXI, the D's 42 to 45 call spread, and that was bought for 46 cents when the underlying was at $40. Now, it helps to dig into a little bit and make sure that it looks like new, opening buyers. In this case, we did dig into it, and I wrote it up because it actually matches a trade from last week, but it looks like it's the same direction. So last week we saw a buyer for 54 cents of that call spread, and with the market down another leg from there, it looks like they came back for more, just because it doesn't seem like they would be able to get out at the level that they got out at. So that's kind of on a macro level. And then another one that we were talking about is some of the energy activity, this is this it's a big shakeup out there. Looking at USO, which is kind of the way that I tend to track the oil market, just because I'm not used to looking at commodities. I mean, look at that, that move. Okay, right? This is now, oil under 50, whatever we are, a barrel. Um, but this is a violent sell-off. For USO to go from 16 down to 11 and a half, and take some of these, take some of the big names with it. I was looking at Marathon last week, which actually had some big bullish call buying at the beginning of last week, and even right here. These are decent moves. These are 2 or 3% between that bottom at 1647, and it was up towards 18 in the middle of a couple of these days. So, I think that there's plenty going on. Especially it depends on what your focus is, but people trading the FANG names, have seen some really big reversals there. Obviously, Apple and stuff is, spooking some people. But it's funny. I was talking to actually JJ Kinahan was at this conference. He's the head honcho at Ameritrade, and I asked him. I'm like, well, so Apple and Facebook are the two largest, most widely held retail stocks. And I said, okay, so Apple down from like 220 to 180. Is this like, is this the end of things? And he said, no. He said, a lot of people are trading around it. He said most of these people are long from well under $100 on a split adjusted basis. And he wasn't. It didn't seem to be scaring him. I mean, if you look at the Apple chart, we're back to where we were in April, I think. So as much as it's a big deal, if you look at it on a year-to-date basis, I mean, it opened up 172, so we're almost back there. But in May we were below that, 162 in May. So I don't know. There's lots of excitement, and then the option volume is off the charts. This year's.
What is the option? What are the options implying for Apple based on what you see? Anything big or?
I mean, if you look at the
or is it tough to tell because Apple's such a behemoth that maybe there's just so much option activity. It's difficult to find an outlier.
There's always two-sided flow in these super liquid names, right? The hyper liquid names, SPY and Apple. It's tough to say yes, it's just bearish paper or bullish paper. We tend to look at. I like to look at things in percentile space and just say, okay, let's just kind of at the highest level, in terms of volatility and in terms of skewness. Okay, so volatility tells you how active, how wild the swings are going to be, and with a 30-day vol around 36, you're talking about 2% swings a day, right? Actually closer to 3 when you convert that into a daily volatility. And then in skewness, it's in the steep end of things, the 80th percentile for that 30-day skew. So there's concern showing, I guess is what I would say. I think that, like I said, when you get these corrections or these big market moves towards the end of the year, you're going to get some people forced to dump their positions. Versus, when it happens in February, March, a lot of people can kind of get away with doubling down or just kind of looking the other way for a few weeks. But you're heading into year end, and most of these funds are going to get marked, for the end of the year. So I think you may see some more kind of liquidation, and just think about the way this world works is people end up in these crowded trades, right? If it's been working well for the last year or two, it pulls people in because everybody hears, oh, gee, so and so's up, 27% because they're long a bunch of Apple, and that's what's happened. And now you're kind of seeing the unwind of some of that, I think. So I would be a little bit concerned about these FANG names that have just had this this incredible run. Looking at Netflix or something as well. I mean, these things are back to, back to beginning of the year levels almost. So, I would, what I've been looking for myself are some real, beaten up names that don't have a ton of, attention on them. If we look at like 52-week lows for the top 100, I mean, some of these are stories, right? Goldman has got their baggage with Malaysia, but staying away from the the ones that you hear about every single day. There's some other names that I think are the opportunities, and then then we just dig into them. Even Citibank. If you look at kind of how that stacks up, you've got super high volatility, and the truth is across the board we're at the high end of the vol. But what I tend to look for is something like this where you have a very high vol and you have a very steep skew. That can make for a nice opportunity for getting in through options. In a case like this, if you think about it, if you want to sell that at the money vol, if you're going to sell anything, and in this case, you could do a collar, you could do a put spread. You just have to be a little careful about which put you're buying, and kind of getting in that way. So, that's what we've been keeping an eye on.
Yeah, Netflix has been a wild one. We traded down to 250 and then up to 272. We're down about 1% on the day. S&P and Nasdaq both down about 1.5% right here. So a lot of volatility. We were down as much as 3% at one point in the Nasdaq. So a bit of a relief rally up. That said, we were down over 3% yesterday, still down 1.5% today. Crude oil traded down to 53.63. I know you touched on that before through the ETF. Right now 54.38. So really interesting move there. What about financials? Is there a way? Are any financials sticking out as any sort of unusual activity?
Let's see. I mean, you can actually see what we've written up today. So put spreads in Morgan Stanley, those are being bought. And in fact, the Morgan ones are rolling some long puts that were opened recently. So, and same thing in B of A. So, the financials are they kind of are the second order pain on, there's some concern about credit and everything else. I kind of, look for the ones that are the most beaten up, and I don't know. I mean, I've been around long enough to see how things play out, and I do think nothing has changed in terms of too big to fail. So, I think you have to keep that in mind. If you see some dire, it's these deep out of the money puts, that can be a great opportunity. Just looking at B of A, some really heavy volume in there today. And let me just see what we're saying it is. These 22 puts bought for a nickel. Okay, that's a $27 stock. Those are these little puts. So, what are they, about 15% out of the money? 19% out of the money expiring in a month. Okay, so they're just nickel puts, but there's some stress there. Like I said, the stress is the opportunity. That's where people do things that that don't necessarily, that they do things that they have to do, not things that they're putting a ton of thought into. So, I would be basically looking for, we may bounce today. I mean, that's what's so funny, right? Is you look at it and you're like, okay, we're down 2%. Futures are down 40 something. You're like, yeah, there's a chance we could be down 70, and there's a chance we could be up on the day. And everybody knows that, and it's kind of changed the dynamics of things. I think there's some great opportunities for these, really short term, 3-day options, that trade for a nickel or a dime, where you certainly got to be aware that those can, you can lose everything on them, but you can also triple your money, that's actually one of the triggers that I tend to keep an eye on, are these super short dated options being sold, because I just think that asymmetrical risk reward. Somebody's collecting a nickel, whether they're closing them out for a nickel or whether they're opening seller for a nickel, because they have a very significant risk tolerance. I think there's some great opportunities to keep an eye on those. Look, here's a sweep of 28 strike calls that expire on Friday. Okay, so this is like I said, what you're seeing is both sides of the coin. These things could be in the money by the end of the day if we turn around, or if some crazy tweet about a China deal comes out, which we saw last week, and it got us a pretty decent bounce that lasted for a couple hours.
Right.
And you just got to be kind of expecting as much as you can, kind of it's like you got to brace yourself. But this is interesting. First they bought 1,000 at 4 cents, and then they bought 2,200 more at 4 cents. That's a pretty aggressive little trade. So we'll keep an eye on that kind of stuff. I just think that the opportunity these days is, for some of these swings where you can swing a percent in 15 minutes, and you don't want to be on the wrong side of it, but you can kind of make yourself get on the right side of it.
Yeah, well, on those swings, Amazon traded down to 14.20. We're now trading at 15.14. That's a few percent right there on one of the biggest names out there. Facebook as well is $7 range on the day. Apple $6 range. Google $30 range. So a lot of ranges out there. A lot of short-term opportunities. But Henry Schwartz of Trade Alert, a lot of great information on his portal. So if people wanted to take a look, I know last time you were talking about some sort of promotion that we could post on our site. If people wanted to get a trial, learn more about Trade Alert, is there something you're running at the moment?
We are, I believe, and I don't remember. I think it was $50 off. Send an email to admin@trade-alert.com. and mention Opportunistic Trader, and we will take care of you with a free trial, and kind of to help you. People that trade know that if you're going to spend your money on something, it needs to pay off. It's an investment. We definitely have a lot of very interesting information, but we also have information that directly works out into trade and into performance.
And you said that email address is admin@trade-alert.com?
Yep. And mention Opportunistic Trader, and we will. Wow, look at this GE 42,000 of these 6.5 puts were just bought for 2 cents. That's a little dire. Yes, admin@trade-alert.com, and we'll be happy to help people out.
Great, and I'll put that in our chat room as well. Henry, I really appreciate you taking the time. A lot of great information there. We'll talk to you another time.
Okay, thanks, Michael.
Thanks.